I am of the belief that readers become leaders. It's my personal philosophy. The bookshelf behind me is testament to the fact that I'm an ordinary man who became intelligent only by reading. Today, I want to share one book which I think all of us must read. And the book is called The Psychology of Money by Morgan Housel. Morgan Housel is a journalist. He runs a fund called Collaborative Fund in the US. He has also written for Motley Fools and the Wall Street Journal before, award-winning journalist. But more importantly, he is a man who is able to translate very complex concepts into easy reading. So you'll have no difficulty. There are no jargons in this book. He tells you the complex concepts in very, very simple manner through a bunch of stories. 19 stories to be perfect. Believe me, reading this book will make you a smarter investor, period. And it's a great investment for anybody who wants to be good in their personal investment journey. That said, I'm going to talk about 8 ideas that I thought were extraordinary out of this book. The first idea talks about the concept of Great Depression. Great Depression in the US was a period where people lost their businesses wound up, people lost their jobs, they were out of their homes, they were thrown out. A lot of negativity, and that's the popular perception we have. Now, when John F. Kennedy was interviewed on his run-up to election about the Great Depression, he actually replied that between 1929 and 1939, the period of Great Depression, his family, which was already well-to-do, they were into businesses and they were a wealthy family, actually became more wealthier in spite of the Great Depression. The lives of different people perform very differently. While most of the country went through a very difficult time, John F. Kennedy's family actually grew their wealth substantially during that period. It's important for us to understand that not everybody is on the same plane. We know less than what we think we know. And that's a very, very important. We should not assume that a worldview, Great Depression means everybody has lost his money. No, there will be sets of people who would have benefited out of it as well. And that's a very, very important concept. That translates even for our own COVID. While COVID was bad, there are people who found ways to profit from COVID and who made money, especially the IT industry. Zoom as a company boomed on account of COVID. So everything need not be looked at from a single file. You need to make that distinction. Second, while it's believed that any decision we make is a very rational decision, we make decisions in a most rational manner, considering our best interest and making sure that in the long run, we're going to be most profitable. That's really the assumption underlying any investment making that any of us makes. But is that the reality? Unfortunately, the answer is no. The reality is that as human beings, we are emotional creatures. So we go by our personal experiences in the past. So if you've been growing up between the age of 15 and 25 at a time when inflation was very high, the value of your rupee or money was going down quite rapidly, then equity is one of the chosen areas where you will put your money, because debt doesn't make sense in an inflationary environment. So you will love to invest into equity products, although they are high-risk products. Even in times when inflation comes down over a period of time, your view, which is constructed based on your early years, becomes the view that you will follow through for the rest of your life. Similarly is the case where somebody starts up life, like I said, at the early adulthood, when inflation is very low, fixed deposits have yielded very, very good returns. He is likely to stay in fixed deposit for the rest of his life because his personal experience is that fixed deposits give great returns, and why take risk on equity market when you can make enough money in fixed deposit? Now, these are all personal experiences we have. And we know hundreds of stories of people who could have made riches in the stock market just putting money away in FDs. We can see that all around us. The reason is that their own experience or their family experience is that stock market is a bad place, and which is why we would stick to safer investment. So, as per the theory, rational investments are made by rational people thinking about profit maximization. In reality, we're all going to make investments based on our own experiences and our beliefs. And that's a very, very important takeaway. Third, the history of investing, the history of financial products is less than 200 years in all. The first mutual fund appeared in US about 100 plus years back. So which means that we have less than 100 years of history. So we are entitled to make mistakes. Our predominant urge as a human being is 5,000, 10,000 years old. The human beings have been walking the planet for 50,000 years. So the genetics of all our urges are more there than this. This is only 100 years old. So you're going to make a lot of mistakes, especially let's say when the stock market has a small volatility event happening, you're bound to rush out of the market because that's what genetics has taught you. That in the good old age, when you were a caveman, your first instinct at the danger was to run. And that's the same instinct that makes us exit stock market in a hurry when things have a volatility, as compared to knowing fully well that we live in a society that's highly civilized, unlikely that even if there's a correction, the market is going to stay down for long, but we are gripped by the feeling of fear that is age old. So this is another view that I got from the book that was invaluable. Nobel laureate Robert Shiller speaks about the factor called luck in investing. That is something that we refuse to believe. Most investors believe that if they get something right, it's because of their ability to research and make a very perceptible choice. And when they lose money on the stock market, it's because of some bad luck or something like that. Unfortunately, it can't be further from the truth. In fact, I have a story wherein I know of a contractor in Bangalore who in the early 90s did some big project for an upcoming IT company at that point in time. The company's promoters did not have money to pay him, so they gave him stocks. He told me he complained and he cursed them at that point in time because money was what he needed at that level. But he settled for stocks because he knew that money wasn't coming there. Lo and behold, the company then went public after a point in time. And after a period of time, maybe 15 years, he got a call from his son in the US saying that the stocks that he held were a bonanza. He had hit jackpot. For the amount of money, his investments had grown by 25-30 times in the stock market boom thereafter because the IT company had done very, very well. There is no way in hell that this man who doesn't understand stock market could have made this as a logical choice. So we underappreciate the role of luck. We need to understand that luck does play a role in investing. That's a very, very important learning that I had. Second, capitalism is very famous for two things: wealth and envy. And he talks about the example of Rajat Gupta. Rajat Gupta was born in the slums of Kolkata and then grew all the way and rose to become the world leader, CEO and chairperson of McKinsey, the often touted global consultancy firm. But that did not stop. He had everything going for him. Yet, he was caught in a scandal of insider trading and thereafter spent time in jail very ignominiously. The point is that why did Rajat Gupta need to do something so silly? He had all things going for him. You see often on the richest of people trying to cut corners, breaking the law for just a little bit more, because envy makes you reckless. You need to ensure that you don't fall the trap of envy so that your decision making becomes reckless. Another very, very important lesson told through the story of what we have. The book talks about the concept of amassing wealth being easier than holding on to wealth. A very, very interesting and an important concept. Creating wealth requires risk-taking ability, courage, and very, very optimistic thoughts and process. Keeping wealth requires different skill set. It involves risk mitigation. You're already up there. You need to ensure that you keep your money away from risk. And they are two very different things. This is played out in the landscape that every 10 years, when the Fortune 100 richest people in the world is announced, you often find that 30-40% of the list keeps changing every 10 years, which means the richest guys have not been able to stay rich all along. There is always a new set of people who become rich. Nothing more than the person who won Kaun Banega Crorepati. He won a 5 crore ticket and he lost the entire 5 crores. Winning it requires different skills. Holding on to it requires a completely different skill set. You need to understand this and you need to hardwire in your mind a fantastic toolkit for all of us to follow. Next, you can get most of your bets wrong, yet create a large fortune. Now, what does this mean? If you have a body of investments reasonably large, then even if a few investments out of that hit great returns, you will still make money. That's the concept which some of the hedge funds use in terms of creating massive wealth. Some of their deep bets give them a 5x or a 10x return, while the rest of the portfolio either performs average or sometimes even underperforms. Yet, the overall hedge fund return is a fantastic return. And that's really the idea. As long as you have a reasonably large body of investments, then you are going to get some of those bets big time. And this is a story that he endows through somebody who keeps buying paintings of artists. And over a period of time, one or two of those artists hit big time and those paintings sell for many hundreds of millions of dollars. Thereby, his overall art collection makes a tremendous amount of money. Last but not the least, it's important to focus on the pattern rather than copying the actual person. Example of this is Rockefeller. In the early 1900s, Rockefeller was a very famous, fast-growing businessman in the US, but he was not fond of law. So he was often found on the wrong side of law, skirting the law towards his business needs. Now, that may have worked for him at that point in time. I dare say that it will work for any of us today. However, one needs to take the pattern out of how he went about building his empire, and that can be adopted even while fulfilling the law. So to that extent, it's important one doesn't imbibe a copycat approach, but understands the pattern and tries to imbibe the pattern. That's where success involves. These are some of those ideas from the book that I thought were interesting. Like I said, there are 19 ideas that the book talks about. It's a fantastic book. Believe you me, doesn't have jargons, easy to read. I loved reading it. I've also reserved one more reading maybe down the line. It's a very, very good book. I hope The Psychology of Money is something that works for you.